Good afternoon, everyone. Thank you for joining the webinar this afternoon. It's just after 3:30 here in Kuala Lumpur. The aim of this webinar today is to be a bit more educational surrounding property as an investment. A little bit about myself. My name is Daniel Carney. I run operations for Fardin Asset Management here in Malaysia. Today I'll be joined by my colleague Val Shipulin, one of our resident advisors based here. So just having a quick look at what we're going to be discussing today. Firstly, I will start the presentation by talking about why Fardin believe property investment is a good idea. One of the key topics in the UK market at the moment is the changes to stamp duty. What are the ins and outs of this and how this can benefit you. We'll give you some information on how you, the purchaser, can assess a property market's investment potential. I will then look at mortgages and the possible tax implications of properties. And finally, we will end with having a quick look at the Eurozone post-COVID-19. So let's get started. Why invest in property? Well, real estate investment can offer huge growth opportunities, high financial returns, while still maintaining a level of stability that makes it a relatively low risk asset. The three main takeaways I get when I look at property investment: capital growth, real estate prices have increased over the medium to long term. I was reading something recently that said UK house prices have more than trebled since the start of the 21st century. Halifax recently revealed 207% increase in the last 20 years. However, the one major drawback with that, it does make it a bit more difficult to buy your first home. Leveraging your capital by securing a mortgage against the property. This enables you to achieve higher returns than you would usually require a much higher level of risk. And finally, tax planning. With efficient tax planning, you can further maximize your profit. Val is now going to take you through the recent changes to the stamp duty tax in the UK.
Hi, good afternoon. Thank you very much for the introduction earlier, Dan. So the key takeaways of a recent act, essentially what is happening is, to kickstart the UK economy due to a pandemic, the stamp duty had a holiday or slight reduction in stamp duty for second property buyers and non-UK residents. So threshold increase basically means 0% stamp duty payable on residential transaction, whether it's your first main residence below £500,000 until 31st of March 2021. It's effective immediately. On buy-to-let purchases, including non-residents, they basically now pay 3% up to 500,000 with no base rate. On average, buyers are looking to save around £4,500 in stamp duty land tax. Just to be clear, the property transaction needs to be complete before the end of March 2021. Come April next year, rates will be reverting back to pre-pandemic levels, as well as a potential 2% increase for international investors. Next slide, please, Daniel. So just to highlight the new rates, for the property worth up to £500,000, your current tax rate for your first property is 0. For the next £420,000, the portion anywhere between £500,000 and £925,000 is 5%. The following £575,000, your tax will be at 10%, and the remaining amount, anything above £1.5 million, is taxed at 12%. For buy-to-let properties, second property, or for non-UK residents, the current tax rate for the property of up to £500,000 is 3%. The remaining amount will be taxed at 15%. For the purpose of this presentation, we're actually going to concentrate on the properties up to £500,000 because that's tend to where all our properties fall into. Next slide. So just to run through a few examples. So executive suite, that's worth around £200,000. Before the recent changes, you would have had to pay around £7,500 in tax. Now you're only paying £5,999, which leads to a savings of £1,500. And at the bottom there, this is a bit that really gets me. you can see what tax rate you'll have to pay in April 2021. So you'll be paying for non-UK residents, you're looking to pay as much as £11,497, which is an additional £4,500 more than you would be paying right now. So for two-bedroom price in this scenario, which is priced around £275,000, before the recent changes, you're looking to pay £11,996 in stamp duty. Right now, you're only paying $8,249, which leads to a savings of $3,747. For two bedrooms, priced around $370,000, you're looking to back before the pandemic, you're looking to pay around £19,500. Right now, you're only paying $11,098, which again savings of $8,498. And comes 1st of April 2021, you're looking to pay as much as £26,995, which is again an additional £15,897 more. If you add that together with a currently weak pound and a record low interest rate, you can imagine it's never been a better time to diversify into UK property. So on the next slide, I will be going through how our experts assess the property market's investment potential. So we recognize there are plenty of private investors wanting to inject capital into residential property markets, but don't actually have an adequate market knowledge to give them confidence to do so. To these days, our investment experts are integral to our ability to identify and track the growth of markets. Now we're going to walk through crucial criteria that our investments experts consider when actually assessing a residential property market potential. These factors should help you actually to identify the direction a given market is moving in. So when reviewing the markets, population growth is one of the key indicators. A growing population is a good news for an investment perspective, as it is a strong indication that the amount of available housing will not be able to meet the growing population demand for it. So long as demand exists, the greater likelihood that the property market value will increase. So the next key point is vacancy rate. You have to ask yourself a question: is a property empty? Do properties tend to get snapped up quickly? This all are good signs that both sales and rental markets of an area are set to increase. It's also a sign that if one of your tenants leaves, your investment property isn't likely to be vacant for long. This is a good news for ensuring a steady and predictable stream of income. The next key point is connectivity. Will there be an improvement to public transport links? Where is the property based? Are travel times about to get slashed? We often see how improvements to transport infrastructure drastically raise property prices. Another key point is regeneration. In simple terms, this is where a previously unloved area gets a new lease on life. We've seen commercial and retail regeneration turn many once unpopular areas into thriving markets for investment, and investment potential in such areas is often stronger than in more established areas due to lower access to market cost. So unique factors is another key point. What are special selling points of an area? It might be that it's making the most of its prestigious heritage, or that it's reinvented itself as a cultural hub. If an area is becoming a go-to destination for a growing number of people, it's worth a closer look. Last one is amenities and institutions. For big corporate offices through to popular university campuses and schools, an area's pool and potential growth tend to be shaped by institutions that are present in or easily accessible from location. For instance, if there is a nearby university with a big international student base, this may drive strong rental demand in surrounding areas. Alternatively, if an area is starting to earn a reputation as a home for certain industry sectors, it could be a positive sign for both rental and sales markets. And next slide, please, Daniel. So to simplify, all our developments cover these few points. They have to be built in a key growth hotspots through the UK. areas have to be identified as having a high demand for apartments for professional tenants, gross undersupply of apartments due to huge infrastructure and regeneration projects, for example, HS2 Crossrail or 770 million Bracknell plan. This provides our clients with a strong capital appreciation and sustainable rental yields. I'll pass it back on to Daniel to do the next slide.
Thank you, Val. Cheers for that. So here I'll be discussing mortgages and possible tax implications of an investment property. As the majority will know, a mortgage is just a loan agreement where you borrow the money you need to finance a purchase from a lender. This in the UK is normally for a bank or a building society. From what I remember, last year Lloyds were the biggest lender in the UK with 20% market share. So that's massive. 1 in 5 mortgages in the UK are getting underwritten by Lloyd. I think second was Nationwide Building Society with about 15-16%. So there's 2 types of mortgages most people go for: interest only or capital repayment. Interest only require only the interest of the loan to be repaid. This is normally favoured by first-time buyers as it requires lower monthly payments, a lot easier, cheaper. This helps people get on the property market. The other option, we've got capital repayment, where you're paying both capital and interest. Obviously, this is larger than the interest only. You're chipping into the actual loan that the lender has given you. If you can afford capital repayment, 9 times out of 10, this is the best option. Once you look to sell, you have equity in the property, whereas with interest only, once you sell, unless the market has risen considerably, you won't make much capital growth. Once you decide whether you go for an interest only or a capital repayment mortgage, you then have to decide what type of loan rate you prefer. The 2 main types are variable and fixed. Fixed rate, pretty straightforward, to be honest with you. You pay the same amount each month for the length of the mortgage. This gives stability, reassurance that even if the central bank does raise interest rates, your monthly payment will still be the same. Variable rates, on the other hand, fluctuates depending on the lender and the central bank. Variable rates are good when interest rates are low. However, be aware when they start rising, your mortgage payments will rise as well. With buy-to-lets, you will have to go for a more specialised buy-to-let mortgage. These loan rates are typically a bit higher than your standard rates due to the added risk. If you're interested in a buy-to-let property, especially if it's in a foreign market, please consult an independent mortgage advisor. They'll be able to guide you through the process from start to finish. We will be able to help you with that as well. Loan rates normally last between 2 and 5 years. You can get up to 10, but I would never recommend that. After these loan rates finish, you can remortgage, look around, see if you can get cheaper deals on the market. Moving on to tax, one of the main questions I get asked regarding property investment is taxation. If you're renting out a property, you need to be aware that you could be subject to income tax. The normal band rates apply for this. So you will have your 12,500 0% tax threshold. However, once you bypass this, you will be taxed accordingly. If you have a considerable property portfolio, you will no doubt hit the higher tax brackets. Municipal tax in the UK, we call this council tax. Pretty straightforward, most of you know this. What you know, the main thing about this, you need to know who's paying this. Is it the landlord? Is it the tenant? If it's a landlord, you will have to factor this into your rental value of the property. If it's a tenant, they can sort it themselves, much easier. Finally, we've got capital gains tax. So you will need to pay capital gains tax on any secondary residential property you sell where the gain is more above your tax-free allowance for that tax year. Something people don't really know is since 2019, your CGT is due within 30 days of selling your property. You'll do this by submitting a residential property return and having to make a payment. If you don't do it within that 30 days, I suspect the taxman will come after you. Capital gains tax rates on residential properties are pretty straightforward. 18% for basic rate taxpayers, 28% for higher or additional rate taxpayers. Obviously, there are certain ways to offset capital gains, expenses, previous year's losses. However, they're always at the discretion of your local tax office. I'd always recommend speaking to an accountant regarding this. Anyways, that's enough about tax. What I'll do is I'll pass you over to Val. Val is going to finish up with discussing the Eurozone post-COVID-19.
Thank you very much, Daniel. So, as you're all well aware, not a single country in the world actually managed to escape the pandemic. As you can see in the first graph, GDP impact from coronavirus was enormous. We've seen as much as 23% fall for second quarter in Spain for their GDP. It was one of the largest among all the major economies. UK suffered as much as 22% fall, US as much as 10%. Apart from China, almost all of the countries experienced double-digit fall. In China's case, though, since it's initiated market reforms back in 1978, the Asian giant has seen an economic growth averaging 10% annually. In recent years, the pace of growth has slowed, however, also it remains high in comparison to peer nations. So why invest in Europe and UK? So UK and European economy is actually experiencing an unprecedented level of growth in investments into biomedical, science and technology industries as a result of COVID-19. Large global corporations such as AstraZeneca, Apple, Facebook are establishing their research and development headquarters all around Europe and UK. COVID-19 has generated an unprecedented demand for laboratory space and research facilities. With UK removing stamp duty, we're also in the midst of a housing boom, as UK and international buyers flock to the market. If you're someone who's basically able to weather a number of shocks, or perhaps you're someone who's not looking to sell in the next 3, 5, or 10 years, then right now is definitely a great time for you to join the real estate. As you can see on the second picture, as far back as 2000, the global house price has been steadily climbing up. Throughout the history, the traditional brick and mortar investments has always been popular with investors due to a sense of security you get from it. Fixed income options at the moment aren't looking very attractive after the flurry of rate cuts. On the third picture, since 2015, the house price has grown faster than income in most countries. The residential sector is set to embark on a different growth trajectory, with home ownership gaining significant preference among the new age millennials. COVID-19 has not dented the demand for the homes that offer value for money. And at last, I would like to quickly run through the difference your interest rates can make. If you wanted to keep your mortgage payment under $1,000 a month, back in 1985, you would get a mortgage of around 11.5%, and that would get you a property worth around 100,000. In 2000, you would be looking at about 7.5% mortgage rate with a property value around 150,000. Right now, however, your current mortgage rate would be around 3.5 to 4%, and you would be able to get a property value over 200,000 for it. Interest rates have come a long way in 30 years. Securing a mortgage now, while rates are still low, you can get more house for your money. Even a small increase in rates drastically impacts the value of your property. You're all well aware, rates are at record low worldwide, and in some countries as low as zero. It doesn't have much room to go lower, and very likely to start back up when the economy starts to recover after the pandemic. That's everything for today. So unless Daniel have something to add, I think we will end the presentation here. So thank you very much.
Thanks for that, Val. Thanks for that, Val. Thanks for listening, guys. If you have any questions, you can drop us an email on the following. And have a good day. Take care.